Good evening and welcome to tonight's Premium Account Live Market Update webinar. The information is prepared for general information to traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation, offer or presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter tonight, myself, Leon Hinde, current Managing Director of Global Equity Management. The format for this evening's presentation, we look at the global macro outlook driving equity markets. We roll through the ASX top 50 companies this evening with a particular focus on the 2013 earnings growth profile and the forward dividend forecasts. We look at price targets based on PE valuations, and we tie in our derivative overlay strategy across our top 50 portfolio and conclude with a short-term Australian market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Up on screen is a graph of the Dow, and I'll just go to the short-term sort of news that's impacted the market. So US stocks were flat as Federal Reserve Chairman Ben Bernanke said the bank wouldn't have infinite ability to address economic fallout from a dive over the so-called fiscal cliff. The Commerce Department reported that new residential construction increased in October from the previous month to the highest level in more than 4 years, so that's just a continuation of the sort of better housing data that we've seen over the last 6 months coming through out of the US. That flowed through to better price stability in the home building stocks in the US. Interesting to note the 10-year treasuries yielding now 1.652, so they've ticked up a little bit off their lows, and I'll have a look at a graph of that in a little. And the 30-year treasuries trading at around 2.8%. In France, just from a European standpoint, France loss of its AAA credit rating and nervously awaited a meeting the Eurozone finance ministers to discuss Greece's financing needs, and obviously just in the short term we've seen sort of a lack of outcome from that meeting. So from Greece's perspective, I think there's really a resolution that's needed there where they're going to need financing by middle of December. So that's something that the market will remain a little bit hesitant on, albeit that I think the market's forming a view that it's comfortable that the ECB is probably going to do whatever's necessary within reason to provide stability for that European region. So from a technical standpoint, the graph up on screen that you have is a graph of the Dow Jones. If you've been following our radio or webinar recordings over the past months, our core view on the equity markets is that fair value for the US based on 12 times the current earnings run rate, and just to kind of reiterate that the S&P 500 companies are delivering on average $25 of earnings per quarter, and that really hasn't changed across the last 6 months or more. Obviously the market's willingness to either discount forward earnings or get optimistic about forward earnings growth has changed, but the reality is that the underlying earnings rate of the S&P 500 companies hasn't changed materially now for some time. The September quarter came in on a relative basis a little bit below that trend of $25, but not in any significant way. So the fair value for the US market is back at 12,500, and it appears that that's where we're probably heading. So it's difficult to know whether we sort of have another leg down in this rally and finally sort of test somewhere in the lower 12,000 range. But broadly, our macro theme is that the market actually finds support within this value range, and we actually get into probably another leg higher in the rally in the early part of the new year. And I think that's largely driven off the back of, again, slightly better data coming through from Asia and the recognition of the support that the central banks are providing asset values, whether that be housing or equity market valuations. And obviously the global low yields is just helping to push cash out of deposits and bonds into high yielding equity plays, and that's a theme that we'll pick up as we roll through the top 50 stocks tonight. Okay, so moving on from the US market, let's just have a quick look at our local market. So our market's trading at around 12.5 times forward earnings, which is a little bit below the historical 10-year average. support for our market from a yield standpoint sits probably somewhere at around sort of 42.50. That would put our market on about a 4.5% forward yield, and I think it's pretty hard to see our market sort of trading too much below that. So tying in with the US, yes, there may be sort of another push down lower if there are delays around either the ceasefire in the Middle East, or whether it's problems around Greece, or whether it be further delays in the Republicans and the Democrats sort of reaching an agreement on the pushing out the tax cuts further. So no doubt there'll be some volatility around this point, but ultimately across a number of months we're pretty comfortable that the market should find support at or near these levels and gradually sort of move higher into the sort of latter part of December, January, February period for equity markets. Now, from a risk standpoint, this is always the gauge that we're watching. We're seeing sort of how global currency flows are impacting around the euro dollar. So given that most of the risks have emanated out of the eurozone over the last sort of 12 months or more, we look at this euro dollar to determine whether we're getting sort of flows out of euros into US dollars, and traditionally when the US dollar rallies, it obviously puts pressure on commodities as a result of sort of the carry trade that exists, and it's a general barometer of sort of risk off when money flows back into the US dollar. So it's important that we start to see a picture here where the euro finds support, and you may recall going back a number of months, again, a base case was around 130 was resistance. We're looking for maybe a pullback into the 127, 126 range, but ultimately we're looking for sort of the status quo to remain, which is where the euro will return back up to around 130 and move sideways. And I think sort of whilst we're in this sort of holding pattern around sort of the policy response out of the US to deal with the fiscal cliff, I think the euro probably stays lower as money, continues to sort of find a home in the US dollar. We're seeing that US dollar index just a little bit elevated at the moment, but gradually looking for, again, getting into sort of that end of December period is to see the euro back up to around 130. Just to run through a couple of other macro sort of graphs here. So the Shanghai Composite, the Chinese economy started to deliver better manufacturing data in October. I think that that's probably the early stages of a slow but gradual pickup in the Chinese economy. I've spent a lot of time talking about sort of the redirection of liquidity into sort of the infrastructure projects that the government is focusing on. And I still think that those type of activities will be resource demanding, but arguably maybe not at the same rate as what we've seen in the recovery or the liquidity supply that we saw following the GFC, which fed into predominantly sort of residential construction in China, which was obviously very resource intensive. The expectation is that the manufacturing picture in America actually looks reasonably solid at the moment, and pleasing to see a recovery in the manufacturing picture in October in China. Where the problem still lies is Europe and Japan, barely keeping out of sort of recessionary levels there. So I still think it makes sense to keep some exposure to the bulk commodities on the basis that we do get at the margin better data out of Asia over the coming sort of 3 to 6 months. Again, from a macro standpoint, the gold trade, our base case has been that gold largely moves sideways, and we really only analyse gold to the extent that it impacts our Newcrest holding within portfolios. So as I move through the top 50 stocks, we'll reference that. If you haven't sort of seen this before, interesting graph, this is the M1 money supply, so the amount of US dollars in circulation. Obviously, as the Federal Reserve continues to expand their balance sheet, printing more US dollars, gold becomes a hedge from an inflationary standpoint. Interesting to see that George Soros has increased his holding in gold ETF substantially of late. So this divergence that we see at the moment is a little bit uncharacteristic, where you see gold actually moving lower while money supply continues to move higher. At this stage, I put that down to profit taking, and I think probably ultimately we actually get, given that this money supply is not going to pull lower, we probably eventually actually do get a move higher in gold again. And for that reason, we're interested in sort of keeping exposure to Newcrest, and again, we'll cover that again as we get into the top 50 stocks tonight. And just finish off on that macro picture. So here's the 10-year yield in US Treasury. So there's been a lot of substantial money managers globally that have got this picture wrong. They've been looking for a pickup in US yields earlier than they have, so through sort of shorting the bond market, and that just hasn't happened. Bonds have continued to move higher and yields move lower. The Federal Reserve's obviously indicated that they intend keeping rates at or near current levels through till 2015. But what is important for the global economy is eventually where we start to see a slight support level build here and a gradual move higher, which will start to indicate that the market is a much stronger believer in the Federal Reserve's policy that it will ultimately lead to a reinflation of asset prices, and as a result drive down the unemployment level and create higher revenues, and obviously create increased tax income opportunities for the US. So whilst we're in an environment where deflation, or this need to continually lower rates to stimulate the economy, you're finally balanced between sort of this deflation and inflation trade, and obviously bears sit in the camp that deflation will ultimately take hold of equity markets, and that's a picture like what Japan's seen, whereas the bulls clearly sit in the other view, which is that the reinflation or inflation will take place. And to some extent you turn to sort of the largest money managers in the world and you sort of look at, well, how are they positioning their portfolios, and someone like Warren Buffett as an example is a fairly long-term bull on the US economy, and not just in a verbal sense. He certainly, Berkshire Hathaway, have a substantial allocation to a recovering US economy, and that's not across assets, equities predominantly. So all right, so with that, let's move into a graph of the first of the ASX 50 companies. So as I go through these tonight, the focus, so for people that are joining us for the first time this evening, our weekly webinars, once a month we tend to sort of drill in a little bit deeper and sort of focus around the PE valuations, likely earnings growth profile into the upcoming earnings season. So around sort of February we start to see the 2012 earnings numbers come in, and as we roll through the top 50 companies, we have a view as to around which companies are likely to deliver earnings growth, whether it be sort of up to sort of 5% earnings growth, 5 to 10% earnings growth, or 10% above. And right at the moment, the 10% above group is relatively small, and that's just reflective of sort of the low global GDP environment that we're in, where companies are finding it reasonably difficult to grow top-line earnings. And we've seen a big focus on cost control contributing to earnings growth, but not necessarily hugely at the revenue line. And again, that's a little bit reflected when you look at the S&P 500 companies there and the flat earnings growth that we've seen there for some time. But as they say, flat is the new up. So as we move through the top 50 stocks tonight, let's see if we can sort of focus on the names that present buying opportunities on this current pullback. So AGK has obviously been hit with some negative regulatory changes, but ultimately the company should deliver double-digit earnings growth, somewhere between 8 to 12% earnings growth. So on this sell-off at the moment, I think it starts to look attractive. This is a name that we're comfortable with, and on forward earnings allowing for that sort of 10% earnings growth, AGK should still deliver around 5% dividend yield. So as it gets down to these levels here, it's not only supported from a future earnings growth standpoint, it should also be supported from a yield standpoint. So we're comfortable being buyers of AGK sort of at or near these current levels here. Asiano, so we're steering clear a little of Asiano. The company had guided towards sort of 15% earnings growth across the next 3 years, going back about 12 months ago, and the data continues to disappoint, and we're not seeing any sort of immediate prospect of that changing. So I think there's other asset allocation preferences over Asiano in the face of sort of management sort of missing some of their guidance that they've been providing the market. Amcor, on the other hand, has been a consistent sort of performer for us. We've owned it from much lower levels, and we continue to buy in on each of these pullbacks. And again, we're buyers of it at or near these current levels. Our preference is to move out into March and sell the 825 calls. So that locks in, or I shouldn't say guarantees, but we have the prospect of the capital gain from current levels up to sort of 825, plus the possibility of collecting the dividend in that March period of around 19 cents. So on an annualised basis, sort of buying Amcor at or near these levels deliver in excess of sort of 20% on an annualised basis if we're able to sort of see the stock trade up towards that $8 level, and whether we get that return through collecting the dividend and the call premium or through ultimately delivering the stock, they'll deliver in excess of 20% return. So from a company standpoint, Amcor should deliver about 8% earnings growth, and I think even with sort of the slowdown in Europe that we've seen, what we have seen is sort of some of the input costs come back a little for Amcor. So any sort of at the margin slowdown in their revenue, I think, is maybe being saved on the cost side. So still looking for around 8% earnings growth out of Amcor. AMP, flat for AMP. I think 2013 earnings will probably track somewhere similar to the prior 12 months. But I think maybe the argument here for AMP is having some exposure to their expanded footprint into Asia on sort of a 2 to 5 year outlook. But right across the next coming months, it's hard to see the market really re-rating AMP. I think it trades sideways, and it's really about owning the stock and collecting the 6% dividend yield. ANZ, so interesting sort of following the banking results, and for those that haven't followed the results closely, just to sort of try to summarise, probably ANZ delivered reasonable growth numbers, up at around sort of 5%, as did CBA and as did Westpac. NAB was the slight disappointment. The common theme across the banking results was there was sort of fairly low single-digit revenue growth numbers. There was a strong focus on cost control to meet earnings improvements, and from a loan impairment standpoint, small to medium enterprise loan impairments ticked up a little, whereas sort of the residential and personal banking side, residential loans and personal banking side of the banks were all a fairly strong point. Throughout the banking season, our main play was to rotate out of the other names into Westpac as our preferred exposure. We're just starting to take another look at buying ANZ across the last sort of 24, 48 hours, but only in a scaled-in way, with sort of mindful of that macro picture on global markets, that if they were to have another sort of push down, the banks could easily be sort of 3 to 5% lower than where they are at the moment. So we're just starting to scale back into ANZ at the moment. On a forward yield, the stock's trading at about 6.5% dividend yield. From a forward earnings outlook, I think again you have to have a view based on the comments that management provided that earnings are still going to be pretty flat over the next 12 months, and with a little bit more of an increase around the concern around the loan impairments. So ASX, so market volumes, the market was looking for a pickup in market volumes into December. Obviously with the fiscal cliff sitting there, it's keeping money managers out of the market waiting for a resolution. And we're seeing sort of market volumes drop off a little bit. Obviously there's still increased volume going through your dark pools or the non-lit market, which could be at the margin impacting volumes. From an earnings standpoint, what that means for ASX is there's highly unlikely that they're going to deliver any earnings growth in financial year 13. I think you're probably looking at maybe a contraction of around 3%. The sell-off that ASX has had down to $29, I think, fully reflects that negative picture, and again, given that December volumes are likely to be below market expectations, I think the market sort of insulated itself ahead of that. At around $29, the stock's yielding over 6% on a forward earnings outlook, and that dividend yield's pretty defensive. So we're still comfortable for new money owning ASX at these levels, but our preference is try to tie that in with a sold $30.50 European call option, where we're collecting the dividends and collecting some call premium, and that as a combination trades delivering a target return of around 15%. So BHP trading 13 times forward earnings. That's with spot commodity prices marginally higher than where they are at the moment. So our core view on BHP is we were buyers of it at lower levels. We've sold the $34 calls into the end of November. So option expiry taking place next Thursday. I think we probably should be pretty safe where that doesn't get knocked out. Our expectation is for these commodity stocks to really bounce sideways, but gradually start to move back up to sort of where we would see sort of a full short-term valuation of around $36. But we're certainly not going to get that until we get sort of that better data out of China and the resolutions in the US. So that at best that's looking at coming through sort of late December, early January. So in the interim, I think it's a matter of sort of, as the 34s roll off at the end of this month, is to look to sort of reset those at around that $34.50, $35 into December and keep the income coming in from holding these BHP positions. Brambles, so 15.5 times forward earnings makes the stock expensive, trading at about a 5% forward dividend yield. What is attractive here with Brambles is I don't think the earnings numbers are under risk. So expectations the company delivers about 5% earnings growth. So I think we're in this environment where Brambles could easily just keep tracking sideways at or near this $7 range. So each time it pulls back, we're buyers of it on the dip, up at around sort of $7.25 to $7.50. We see it fully valued. So we're buyers of the dip and then selling sort of those calls into March at around the $7.25 level. Again, trying to sort of set those via a European option and collect the upcoming dividend as well, delivering a target annual return there of close to 20% out of Brambles. CBA, so most expensive out of the banks. It's the next bank to go ex-dividend, so I wouldn't expect this sell-off to really get too much traction. I think as it sort of pulls back, you'll start to see money sort of pile back into CBA. But at sort of 13 plus times earnings, this bank was getting a little expensive, again, given that sort of very low single-digit earnings growth into 2013. But in general, the Australian banking sector, I think it just makes sense to gradually accumulate some of these on this current pullback. Coca-Cola, so very expensive PE, trading at about 17 times forward earnings, delivering about 5% earnings growth. The market obviously excited about defensive income or dividend plays, and from a technical standpoint, the pre-alert indicators, generally when you get sort of this higher high, higher low pattern and the accumulation indicator coming in, you will get some sort of rally. So we're looking for maybe Coca-Cola to move back up to sort of $13.75. Then I'd expect it to run into some resistance there again. But we've been buyers of it just recently, sort of off this sort of $13 level, with a view that it sort of stays well supported into December. Not doing anything there in CFX. So Computershare. So this is one of those interesting companies that we sort of feel that having exposure into a faster growing US economy over the next sort of 3 years, Computershare with the BNY Mellon transaction that they did with taking over the share registry business in the US, we should start to see the first real meaningful integration of that in the financial results that Computershare reports in sort of February, March. So expectation is that they deliver around 10 to 15% earnings growth, so one of the few companies that are in that double-digit category. The stock is trading reasonably expensive at the moment, about 15 times earnings, but assuming that that earnings growth does come through, which I would rate that as a pretty high certainty, the stock still remains reasonable value at $8.50 on sort of more of a 6 to 18 month outlook, and I could see that it's possible that Computershare gradually re-rates over the next sort of 12 to 24 months back up into that sort of $10 range. So we continue to be interested in Computershare as a buy on the dip type strategy. From a short-term perspective, owning the stock here, selling sort of the 875 calls into December, and again that's trying to deliver around an annualized return of around 20%. based on sort of that 3-month trade there. CSL, 20 times forward earnings. The company's in the second stage of their share buyback, another 900 million that they're enacted, and that'll sort of ensure that any sell-off in CSL is well bidded. So the company's likely to deliver about 10 or 12% earnings growth, but given the cancellation of $1.8 billion worth of shares, when you start to look at that earnings growth on a lower share base, the earnings growth picks up a little. So yes, the stock is expensive, but whilst the company's conducting sort of this share buyback, which should carry on for another 6 to 8 months, I think you've got to be prepared to sort of be a buyer of the dip on any sell-off in CSL. Crown Casino, not doing it there at present, nor in Dex's property. Fortescue. So our strategy on Fortescue, we'd sold calls at the 450 level when the stock rallied into the end of December. So with iron ore pulling up from sort of low 80s back up to 120 a tonne at the moment, really for Fortescue to recapture these sort of $5 levels that it was trading, we need to see iron ore pushing back up towards the 140 a tonne range, and that's just simply not going to occur whilst we've got sort of these issues that are holding us back with Europe and the US. So again, I think it makes sense to try to drive income out of a stock like Fortescue, but ultimately with a view that into sort of that first quarter of the new year, in preparation for the possibility that the stock rallies a little bit higher. From a technical standpoint, and as I move through some of these stocks, I'll just reference sort of what we're seeing from a technical picture. Generally, when you do get the lower low, lower high structures, the distribution signal will often be a reasonably accurate sort of top for that downtrend. Our expectation, though, is that the stock probably mainly sort of moves sideways rather than necessarily takes out an historical low. So I think sort of a good part of the price adjustment's already happened. The price bounces sideways from where we are at the moment. Goodman Group doing good things within the property sector, but not on the radar at the moment. GPT we actually like from a valuation standpoint and earnings growth, so we're interested in GPT sort of on any sell-off below 340. IAG, a little bit expensive. We were buyers of IAG at lower levels. We'd sold the calls at around 425 into December, and I wouldn't be surprised to see IAG sort of pull back and settle around this sort of 430 level. So I don't think we'll be too far off the mark with delivering that stock into the option expiry. And it really would be well supported at still above $4, so expecting it to sort of finish the year consolidating around 430. Iluka, not doing there at present. IPL, so this is a stock that reports sort of out of sync with the majority of the market. They reported their results last week. And whilst on a year-on-year basis, the results came in about 20% below the previous corresponding period, the real sort of pleasing outlook for Incitec Pivot is the commissioning of the Maramba project should deliver an additional $75 million of EBIT earnings in the 12 months ahead, with that gradually increasing up to $150 million over the next sort of 3 years. And that's a fairly substantial increase when you consider that the company on an annualized basis is only delivering sort of around sort of $400 million at the moment. So from a valuation standpoint, the stock's at about 10 times earnings, and I think the outlook for both their fertilizer division and the Dyno Nobel, the explosive business into the US, which had a very strong period over the last sort of 6 to 12 months. I think the expectation here in IPL is that it's one of these companies that can deliver 10 to 15% earnings growth and should sort of recapture this $3.50 level. So we're buyers of IPL on the dip. Leighton, so we're looking for them to finalise their deal with the sell down of the next-gen telecommunication business. That'll bring in about $1 billion. The company's targeting lowering their gearing, which I think is just too excessive at the moment at 45%, trying to get gearing down to around 25%. So the sale of this next-gen asset is reasonably important, so we sort of keep a focus on that. Certainly if Leighton's manages to get their gearing down to a reasonable level, I think there's a reasonably compelling argument that if you're buying into the view that the global economy will ultimately re-accelerate on a sort of 3 to 5 year outlook, that Leighton's is gradually starting to sort of get down to somewhere that may reflect a cyclical sort of low in their business. But so on our radar, but not setting new positions yet. A little the same with Lendlease. We like it from a valuation standpoint, about 9 times earnings. They should deliver about 5% earnings growth. It's a fairly defensive allocation within the property play at the moment, so completely different risk profile to Leighton's. I think the volatility around Lendlease is a lot less, and we'd expect it to largely move sideways over the coming months. Macquarie Group been very interesting. So from an earnings standpoint, the company delivered about $700 million of earnings. Now, that was when the stock was trading back at around $24. We've since rallied up to trading almost $31. A big part of this push has been driven by the share buyback, but nevertheless there's a fairly bullish signal here that money managers have been willing to set long exposure into Macquarie as a global investment bank, and I think that's really predicated around sort of this view that global reinflation will take place over the next sort of, beginning sort of 1 to sort of 3 to 5 years. Now, what that means, though, from a short-term valuation standpoint for Macquarie is the next forward 12 months of earnings needs to deliver about a 30% earnings increase to support the current valuation of the shares, which would be meaning that the company's needing to deliver about $1 billion profit. And that's a bit of a stretch at the moment. So our preference is still to be a buyer of the domestic banks on the pullback rather than really chasing Macquarie at these levels. NAB, so from a dividend standpoint, pushing up back above 7%. I spoke about sort of the earnings results for NAB probably feeds into a very minor 1 to maybe 2% earnings downgrade into 2013. So our preference still remains Westpac based on a number of metrics where we think sort of internally the Westpac business seems to be doing better than the others. Newcrest, so we looked at the M1 money supply at the beginning of the presentation. So our case here with Newcrest is we'd sort of sold the $30 calls when the stock had rallied into the end of the year, and we've collected reasonable income off those. We've seen the price pull back. We've been looking for a buy point of around this $25 level, and I think the issues facing Newcrest are not only related to the gold price, but obviously production. And the real issue here for Newcrest is current production's down about 25%. If we can get all things being equal where gold at least stays at on their current levels, if not moves higher, and you get an improved production picture in Newcrest over the next 12 to 18 months, then that's where you get the big re-rating in Newcrest, where you could see the stock price trading, back up towards sort of $35 levels. So for that reason, I think it's worth sort of being a buyer of Newcrest on some of these pullbacks. News Corp, again, 10% earnings growth, looking for the upcoming split between the new and the old media assets in the new year to sort of unlock further value for shareholders. Again, from a technical standpoint, when we see these accumulation signals on these high low structures, often they provide a reasonable level of support. So I'll flag that channel there at around $23. Interesting, if we do get another slight pullback off a little bit of US selling, it'd be worth maybe starting to take a look at Newcrest just from a short-term trade from sort of now into the end of December. Origin, so to look at Origin from a fundamental standpoint, the company's gone from 18 months ago forecasting earnings growth of 10% to now delivering a contraction of around 5 to 10%. And the market's punished Origin, and it's unfortunately sort of been the perfect storm in that they've had sort of the regulatory issues, the cost overruns in the LNG development or project, and then also the issues here that are impacting Origin, being the delay with the sell down of their 7.5% stake. So the JP Morgan should probably finalise something by the end of March in relation to the sell down of that stake with ConocoPhillips. So the catalyst for Origin, I think, is that you're almost buying the business just for its utility assets at present and getting somewhat of a very deep discounted exposure to their LNG project. From an income standpoint, if we assume that the company is going to deliver roughly 5% earnings contraction, the stock's trading on about a 13 times multiple, and it's currently delivering close to a 5% dividend yield on a forward outlook. So I think sort of somewhere around $10 we're probably looking at the support level for Origin. So my expectation would be that we're in this environment where probably we're not going to get a major re-rating until we see news come out on the sell down of the transaction that JP Morgan's managing for them, the LNG asset. So whilst it's probably tempting to have an expectation for the stock to move substantially higher, our base case is we're happy owning it here, but you do need to be selling sort of reasonably tight covered calls. It's an income trade as it bounces sideways, but ultimately into the new year we would expect to see a re-rating and the stock trade back up towards sort of $12. I reckon not doing there at present. Oil Search, again, another example of cost overruns in the LNG exploration side of the business, and the market really punished Oil Search off the back of that. In saying that, at around sort of this $7 level is where we've always sort of had a view that fair value, so we purchased Oil Search at lower levels, and we'd sold the calls at around this $7.25 to $7 level going into December. So we're comfortable that the stock price is sitting back at or near our fair valuation range, and at the end of December we'll have a look at rewriting those calls and driving more income out of the basis that we sort of see Oil Search back at fair value. But again, on sort of a 1 to 3 year outlook, I think the drilling results that Oil Search are likely to continue to announce to the market will provide adequate support for the share price on any sort of major pullback. Qantas not doing there at the moment. QBE, so again, insurance margins, just when the market started to get a little bit optimistic about insurance margins creeping back up into low double digits, the company's disappointed with margins back down at around 8%, and that's sort of been the trend sort of through each of these sell-offs. The expectation is that that margins improve, then they disappoint. Margins improve, disappoint. Margins improve and disappoint. So I'm just tied in with the fact that we sort of have this low yield backdrop in the US. I'm not sure what the catalyst is to really drive QBE higher in the short term. QRN, so it's expensive, but I think it's reasonably defensive. The latest haulage numbers come out show that the haulage volumes are pretty much flat year on year. So the argument for any excessive share price movement to the upside is pretty limited from these levels. But I think as this sell-off occurs, any opportunity to buy QRN at around this sort of 340 level should be reasonably well supported. Rio, again with iron ore at 120, Rio's trading at about fair value at about 11 times forward earnings. If iron ore kicks back up to 140, we get the re-rating back up into the $65 range. At the top of this sell-off here, we'd sort of sold the calls at around the $62 level, and again that gave us an opportunity to drive income out of Rio whilst we're sort of waiting for this recovery to take place. We've been buyers of it at lower levels and capping sort of calls out anywhere from sort of this $58 level through to sort of $62. Most of those will expire, and that'll give us the opportunity, providing Rio sort of remains in this sort of current band up at around $57, to actually reset those calls into the sort of early part of the new year, closer up to around $65, and that ties in with our macro view that we think the sort of that better data out of Asia, a refocus around US debt ceiling, which will feed into a weaker US dollar, which at the margin will be more supportive for commodity prices, should sort of create a scenario where these bulk commodity names stay somewhere sort of elevated around the current levels. Again, from a technical standpoint, I flagged that we are in a negative turning point structure, and we do have sort of a grouping of these signals, which is often a cluster associated with sort of a downtrend. But again, given that our view is that iron ore prices are not likely to go back and take out those lows of a few months back and are in an environment where we do get better data out of China, then it's hard to sort of get too bearish on these names. So our preference is to try to play them on the basis that they're moving sideways across the next couple of months, and then take another look at them at the end of December and see if we can sort of reset those calls higher, if that's still our core view going into sort of that first quarter of the new year. Stockland, slightly negative earnings outlook going forward. Nothing that probably wouldn't miss much more than 3 to 5%. Again, on a forward earnings outlook, and I think that sort of feeds into a reasonably well-supported dividend story. So at around these levels, the stock's fair value, simply based on a dividend yield, and I think it tracks sideways somewhere around this 350 level. Sonic Healthcare, so the initial pop in Sonic came off the back of a slightly better outcome on the pathology rebates that they're having to give back to the government, where those could have been, the market was allowing for up to sort of 2.5%. They ultimately came through nearer to the sort of 1.5 or 1.2% at the lower end of that range. So that's what caused this initial pop. Interesting that the selling hit hard today, and I'm yet to sort of see any news that around that, or whether it was just sort of an institutional portfolio sort of offloading their allocation to Sonic. But we see Sonic as sort of 5 to 10% earnings growth over the next 12 months. And you can see the range on screen there that I see Sonic as being value. So any sort of sell-off back down to around this 12.50 level, I think, is a buying opportunity. And I think the story for Sonic really is that it's just supported by yield, a 5% forward dividend growth, dividend yield, and the company delivering sort of 5 to maybe 8% earnings growth. So I'd expect it to be bidded up on sort of any sell-off around this 12.50 level. Santos, always been concerned here from a valuation standpoint. 15 times earnings, flat revenue, flat production over the last 12 months. Not sure what the catalyst is to really sort of kick Santos out of the current trading range. So at around $12 we've been selling covered calls, and it's just driving income out of owning Santos. Again, I sort of flagged from a turning point structure that we have sort of a fairly negative structure here with the shorting signals present. So the likelihood is that sort of the pressure remains a little bit to the downside on Santos over the coming months. Suncorp not doing there. Sydney, so the traffic numbers in October were good. I think at a 6% yield, Sydney's airports are supported on any pullback. So we're looking for it to come back at around 325. Not sure whether we'll get that. I think that'll probably only occur if we have a steeper sell-off in equity markets and sort of people hit the sell button across the board. But from a yield standpoint and from an underlying business perspective, it's performing much stronger than even we expected. We were buyers of it at lower levels, and we've sold out at around $3, with the call options collecting a return of around sort of 310. This last leg of the rally's been a little bit of a surprise, but certainly happy to buy back in if we get a pullback down into that 320 range. Transurban sort of full value here at around $6, trading sideways. Telstra, so a little bit of selling from today's high, but a great run that Telstra's had. The yield's pushing down to sort of sub 6.5% now. But the interesting thing to note there is obviously that, as I've mentioned before, the company's paying out 100% of earnings in dividends. So the bullish story for Telstra is obviously quite dependent on a continuation of the NBN deal being finalised and their coffers being filled with the cash component that will come through from the sale of the NBN network, or the old wireless network, the copper network. So from Telstra's standpoint, there's an argument there that Telstra could easily trade down to a 5% dividend yield, in which case the stock's worth $4.50. If interest rates continue to move lower in Australia, then these defensive yield names will continue to find money flowing into them and valuing them not on an earnings standpoint, but valuing them on a relative spread between the dividend yield and the rate that effectively you're getting in a cash management account. So I think sort of across the board, whilst Woolworths, Wesfarmers, Telstra, Coca-Cola, they're all expensive. The probability of them having any major move to the downside is only going to be predicated on the back of a sudden reversal in the outlook for global GDP and interest rates in Australia moving higher, which will diminish the attractiveness of sort of some of these sort of lower growth, high yield names. But for the time being, I think the majority have an expectation that interest rates are continuing to move lower in Australia. And the whole reason that's happening is obviously the RBA's concern that the mining industry is slowing down, trying to create extra demand within sort of the retail consumer spending side of the market and the housing construction market. So if we sort of maintain that line that interest rates are going to be at current levels or possibly moving lower, then some of these names, these defensive yield names, still remain attractive. From Toll's standpoint, flat earnings growth, but are getting close to a 6% dividend yield. So on a forward earnings outlook, we're not looking for growth out of Toll, but maybe, again, from a defensive yield point, there's an argument there that the stock's back at sort of a fairly attractive valuation level. Westpac, so it's held up well relative to the other banks. So I think we were sort of justified in sort of shifting out of a lot of the other bank allocations into an overweight position in Westpac, and a little like ANZ at the moment. Our view here is that the US markets may have another move lower over the next week if we don't get sort of clarity out of the policy responses there, and that would be a buying opportunity. But otherwise, we're still keeping sort of long exposure to Westpac. We'd sold the 25.50 calls into December, which complemented the income that we collected from the dividend as well. So looking for sort of Westpac to stay pretty much within sort of that value range that I've indicated on the screen there. Westfield, a little bit expensive. Dividend yields down to around 4.5%. I think the earnings growth pictures probably somewhere in the order of a 3%, 3 to 5% maximum. I think the stock's sort of pretty much fully valued up here, so we're looking for a pullback below $10, but again sort of mindful of the correlation between sort of this interest rate environment and money seeking yield at present. Wesfarmers, 17 times forward earnings. The market's already paying up for 10% earnings growth. We've seen a little bit of negativity around the outlook for the coal volumes and the revenue and profit contribution from their coal division, and that's completely separate to their coals division, which is growing at around sort of low double digits, which is I think the expectation is that's probably likely to deliver again somewhere between 8 to 10% earnings growth. So I think the story here for Wesfarmers is that at 16, 17 times earnings, 10% earnings growth already priced in. Again, you'd have to assume that the price is more than likely just simply going to bounce sideways. So our strategy here is owning Wesfarmers at this level, selling the European call into March, collecting the upcoming dividend, and that's delivering around a 15% annualised return on the basis that Wesfarmers simply moves sideways at or near these levels. Worley's not doing there at present. Woolworths, same story as Wesfarmers, trading on expensive PE, yielding in the high fours. The issue for Woolworths is that they're probably likely to have a higher capital expenditure budget than Wesfarmers, and I think as the market starts to realise that, there's probably a little bit more risk that Woolworths underperforms Wesfarmers. But look, splitting hairs, I think basically both companies are trading on a fairly high multiple, but have a defensive yield of around 5%, and the stock price should sort of bounce sideways. Worth noting that Woolworths earnings growth is only around 5% versus Wesfarmers up at around 10%. So Woodside Petroleum, we like Woodside given that the better news out around their forward production growth numbers, and I think again as we get into sort of the first quarter of the new year, I'd expect that we start to see the market more excited about sort of that improved production outlook for Woodside Petroleum. So we're looking for a target price of around $36 over the coming months out of Woodside. WRT, so we've been waiting for sort of this pullback at $3. It trades at about a 6.5% yield, so I think it'll be well supported on this pullback. If we saw a move back down to around $2.95, we'd be buyers of Westfield Retail Trust just on a short-term trade into the upcoming dividend. And to conclude tonight's presentation, with a short-term market outlook. So up on screen is a graph of the top 50. So our base case for Australian equities, we've been looking for the market to sort of pull off into this sort of sell-off range that we've got indicated here. So if we tie that in with the US trading around 12,700 points, the risk is that maybe the US moves 3 to 5% lower. Or let's say 3% lower down to around 12,100, 12,200 points. That would tie our market into moving back down to around 4,300 points on the top 50 index. And I think the base case is that that presents value. Our market's well supported by yield. Global GDP should at the margin start to re-accelerate once we get through these issues that the US policy are dealing with, and with central banks sort of firmly sort of willing to step in with the right commentary and action during any sort of market sell-off. I still think it makes sense to have a long exposure to equities, and we're sort of quite optimistic about this sort of current sell-off and the opportunities that it presents across the market. Thank you for listening in, and I look forward to speaking again in the next public webinar recording.